Welcome back to my channel, ladies and gentlemen. So in today's video, I'm going to be sharing with you a powerful trading strategy that will make you money on the forex market. So we're going to be looking at the candlestick pattern trading course. Candlestick pattern is one of the most important trading strategy as a price action trader. That is why candlestick pattern is very important. As a forex trader, you need it so that you can be able to understand the right place to take your trade and the right place to exit your trade. So what you are going to learn in today's video is candlestick pattern, everything you need to know about candlestick pattern. So this tutorial video is meant for beginners and advanced traders. So what I would advise you to do is make sure that you watch this video from the beginning to the end, and also make sure that you share this video, give us a thumbs up, and don't forget to subscribe to my channel for more updated videos. My name is Austin in Ikeru, and you all are welcome to Ostino FS. So let's start. First, what is candlestick pattern? Candlestick pattern was invented by the Japanese. They use it for identifying entry and exit for their strategy, and it has become so important that you need to understand what a candlestick pattern is. So candlestick pattern is essentially meant for the ability to read price chart. Candlestick pattern helps you to be able to read the price chart, to know what the market is doing, right? That is why in my first video I talked about price action, and I told you that this channel is going to focus mostly on price action so that you can learn how to profit in the forex market. So candlestick pattern helps you to be able to read the price chart, to know what the market is doing, and to know when to take your trade and when not to take your trade. So now there are some important things you need to understand while trading using the candlestick pattern. First and foremost, you need to consider the opening, the highs, the lows, and the close. Let me give you an example of what I'm talking about. You can see this is a candlestick, right? This is a candlestick, right? This is a candlestick. This is a bullish candlestick, and this is a bearish candlestick. So for you to be able to read the candlestick, you should look at the high, the low, the close, and the open. These are the four things you need to understand concerning a candlestick. Now this green signifies bullish, that is uptrend, while this red signifies bearish, that is downtrend. Some people use black and white color to differentiate between the bullish and the bearish, but the most popular color that we use to identify the bearish and the bullish is the green and the red. So when you see a candle with red color, you know that the market is going down, and if you see a candle with a green color, you know that the market is going up. So now the market open from here. If it's an uptrend, if the candlestick is bullish, the market opens from below, which is here, and closes above, which is here. So the highest high of the market is the high. This is the high where the market reach, and this is the low where the market reach. So if the market opens here and drop here, this is the lowest of this candlestick, this is the lowest, and then goes up, this is the highest, forming this wick, and then close back here. That is why we have the open, we have the low, the high, and the close. The same thing is applicable to the red part. You can see in the red part, which is the bearish, the market opened from the top. Remember, the market opened from the low, from the bullish, but from the bearish, the market opens from the top. So the market opens here and closes below. So this is the lowest of the market, and this is the highest of the market. Let's say for instance, the market opens here and then goes up a bit little. For instance, goes up to tell you that the market moves a little up, and then comes down all the way to this level, which means this is the lowest that the market went, and then closes here, which tells you that the sellers are strong here while the buyers are strong here. So this is how you read the candlestick. You look at the close, you look at the open, you look at the high, and look at the low. These four things are very important. So you can see that the candle makes an upper shadow, which is called the wick, the lower shadow, which is also called the wick, and the body. So you can see this is the upper shadow, this is the upper shadow, this is the lower shadow, this is the lower shadow, and this is the body. You can also call this a wick, right? Rejection. This is a rejection. Call it a wick. Look at it, rejection. So this is the body. So when you see this kind of candle, you know that the buyers are strong. And if you see this kind of candle, you know that the sellers are strong. So that is what we are talking about. So this is an example of what I'm talking about. So if you see this candle now, you can see that the buyers are very strong. So the candle open here without any rejection down here. So the candle open here and went up. This is the highest that the candle went, and then closes here. So this is a strong bullish candlestick, a strong bullish candlestick. So let me give you example again. That is another example again. You can see it, a strong bullish candle, which tells you that the buyers are very strong. So if you identify this kind of candle in your price chart, you know that the buyers are strong. You can see another example here. This another example here. So this is a weak rejection, right? But this tells you that the buyers are strong because the price opens below and went all the way up here, making this small rejection. You can see that the rejection is very small, which tells you that there's a weak price rejection here, but still the buyers are very strong. They are in control when you see this type of candlestick. Then this another one again. You can see this is the open and this is the close. So these things are very, very important. If you don't know, they are extremely important while trading the candlestick price action. This is another example I have here with me. You can see that this is another candlestick pattern, right? This is another candlestick pattern. You can see that there's a long wick here, a strong price rejection. This tells you that the buyers are weak because there's a strong rejection. The price opened below here, went all the way here, and at the end the price made this long rejection only to close here, telling you that there's a weak bias in this market for the price to make such a strong price rejection. So when you see this type of candlestick pattern on your chart, you know that the buyers are weak. When you see this kind of pattern, you know that the buyers are weak and the sellers are about to take control of the market. So this is a strong indication that the sellers are about to take over and that the buyers are weak in the market. So we are going to treat this one after the other in this video. So this is another example here. You can see the price open and closes here. The price opened below here, went all the way here and made the rejection and closes here, telling you that the buyers are very weak while the sellers are about to take over the market. So you can see another example here. This is another example here. Price open, went high, made the rejection and closes. So this is a signal that buyers are weak in the market and the sellers are about to take over the market. So this is another example we're talking about. So if you see this type of candlestick, you know that the buyers are strong because the market opens here, makes a small down move here, and then goes up all the way here and then closes here. This tells you that the buyers are strong because there is a very big body in this candle, which tells you that the buyers are strong. You can see the small wick. The small wick tells you that the rejection is very low, and the big body tells you that the buyers are in control. So when you see this kind of candlestick, you know that the buyers are still in control of the market. Then when you see this type of candlestick, if you see this type of candlestick, this candlestick is called a doji, right? It's like a cross. this is a sign of indecision. So if you see this kind of candlestick in a higher time frame like the daily time frame, if you move over to the 5 minutes or 15 minutes, it will tell you another story. Now the market opens here, this place, went all the way down here, which means the sellers, immediately the market opens, the sellers push the market down to this point. Then the buyers now got into the market again, push the price up all the way to this level. Then the seller come back again, push the market down, and the market closes here. This tells you that the buyers and the sellers are in equilibrium. So there is an equilibrium between the buyers and the sellers. So that is why the price was able to close here. So when you see this type of pattern, you know that the market is in a range because the buyers and the sellers are in equilibrium. So that is what you need to understand about this pattern. Then looking at this pattern again, this is also a candlestick pattern, right? This is a candlestick pattern too. The price open here, right? The price open here, and then the sellers took control, push the price all the way down to this place. Then the buyers came into the market and then push the price up to this place and closes above here, which tells you that the buyers are in control. First, the sellers came into the market, they pushed the market down to this point, and the buyers now came in and then pushed the market all the way to this top and then closes above this. So when you identify this type of candlestick on a chart, you know that the buyers are in charge of the market. So this tells you that the sellers are weak while the buyers are strong in the market. So this is how you identify a candlestick pattern in different time frame. Like in the 1 hour time frame, you can identify the candlestick pattern like this. This is called a bearish engulfing pattern, right? Because the market opens here, right? And the buyers took control, pushed the market up to this point. Then the market came back here, right? And then went all the way down and engulfs this entering, right? Which tells you that the sellers are in control because the buyers came here, pushed the price up, and then the sellers came and pushed it down, making it to engulf below this green candle, telling you that the sellers are in control. So this is a candlestick pattern known as the bearish engulfing pattern. So when you identify this pattern, you know that the sellers are in control. So you can see this type of pattern in the 1 hour time frame, but when you come to the 2 hour time frame, then you now see this type of pattern here. You see this type of pattern in a 2 hour time frame, right? This is what we mean by the this another pattern known as the shooting star, right? So this is the bearish engulfing pattern, and this is the shooting star. Now you can see that the buyers, took control, which is here, and then push the market up, right? So this rejection is this red. So the market got here, and then this rejection signifies this red, which means that the sellers are in control. Now they now push the market all the way down and it closes below, telling you that the sellers are in control. So these are the most important thing that you need to understand about the candlestick pattern, so that you don't take the wrong step while trading the forex market. So we are not going to look into the candlestick patterns. There are various candlestick patterns, but we are going to pick the most important ones, the ones that have at least 90% win rate, the ones that once you identify them, know that this is going to be a winning trade. So there are many candlestick patterns, but we are going to look at the most obvious one, the ones that are more reliable. That's what we are going to look at. So we are going to look at them one after the other. Now first we have what we call the bullish engulfing pattern. This is a bullish engulfing pattern, right? Here you can see that the market was formerly in a downtrend, right? And then the sellers were in charge, pushing the market down, because you can see that the market opened from here, and then the sellers pushed the market down, only for the buyers to come into the market and push the market up to the extent that it engulfs the sell and went up. telling you that the buyers are in charge of the market. The market opens here, the seller push the market all the way down, and the buyer step in and push the market all the way up, and it engulfs the sellers, which tells you that the buyers are in control. So when you see this type of a candlestick pattern, you know that the buyers are in charge. Then the next one we have here is this. This is called the bearish engulfing pattern. This is the bearish engulfing pattern. You can see that the market was formerly in an uptrend. The market opened here and then started heading up. The market was in an uptrend, and suddenly the buyers came in and then pushed the market down to the extent that the market engulfs the buyers and continue going down, telling you that the sellers are in control. The market opened here, and the buyers push the market all the way to this level. The sellers step in and then push the market down to the extent that the market engulfs below this green candle, which tells you that the sellers are in charge. The sellers have stepped in and they are now in charge of the market. So whenever you see the bearish engulfing pattern in a chart, you know that the sellers are in charge of that market. The sellers have stepped in and they are in control. So you should be looking to sell, not to buy. Another example we have here is the hammer. The hammer is related to the bullish engulfing pattern. This tells you that the buyers are strong in this market. What happened is this: the market opens here, right? This is where the market opens. Then the sellers took charge. Immediately the market opens here, the sellers took charge and pushed the market all the way to this level. This is where they push the market to. The sellers push the market all the way from here. Immediately the market opens, the seller push the market all the way from here to this level, right? Then the buyers step in and then push the market all the way from this level to this level, to the extent that the market closes here, forming this hammer. This tells you that the buyers are in charge of the market, because the market opens here and the sellers push the market all the way down. The buyers came into the market again and then push the market all the way up, and the market closes above here, telling you that the buyers are in charge of the market. So the next candlestick pattern that we have here is known as the shooting star. The shooting star is a candlestick pattern that tells you that the sellers are in control. If you watch, you see that the market opens here, right? It opens above this place, and then the buyers came into the market and then pushed the market all the way to this level, right? The market opened here and the buyers push the market all to this level. Then later on, the sellers step into the market again and then push the market down to this place and then close below here. This tells you that there is a strong price rejection, telling you that the sellers are in control of the market, because formerly the buyers were in control and later the sellers stepped in and took over the market from the buyers to the extent of pushing the price all the way from this point down to this point and finally closes below here. So this is known as a shooting star candlestick pattern. So when you identify this candlestick pattern, it means that the sellers are in control and you are expected to take a sell trade. Then the next candlestick you have here is known as the morning star. Morning star is a candlestick pattern that is telling you that the buyers are in control of the market. At first, the market was in a downtrend, which is this big red candlestick, telling you that the market was in a downtrend before. Then suddenly the market went into equilibrium, which gives you this doji sign, this plus sign, telling you that the market later went into equilibrium. Here the buyers and the sellers were exchanging price. First, the market was in a strong downtrend, forming this long red candlestick. Then after that, the market went into equilibrium, which is range. The market had to range where the buyers and the sellers were in equilibrium, which gave us this doji candlestick, and then, or should I call it this a plus. Then later on, the buyers step in and then push the price up to become the same level with the the bearish candle. Now you can see that the buyers step in and then they push the price up to this level, telling you that the buyers have stepped into the market. So when you identify this type of candlestick pattern in a chart, it tells you that the price is going to go up. So you are expected to look to buy when you identify this type of candlestick pattern, because in this type of candlestick pattern, the buyers are in control. So the next candlestick pattern we have here is known as the evening star. The evening star candlestick pattern is telling you that the sellers are in control of the market. It's an opposite of the other candlestick that we just discussed. Here, the price was formerly in an uptrend. You can see that the price opened here and the buyers pushed the price all the way to this level, telling you the price was formerly in an uptrend, forming this big green candle. Then later on, the price went into equilibrium, giving us this doji candlestick, or should I call it this plus, telling you that the price is now in equilibrium, where buyers and sellers are exchanging price, or in other words, they call it a ranging market. Then after on, the sellers step into the market and then push the market down to this level, telling you that the sellers are back into the market again. So this candlestick pattern is telling us that the sellers are in control of the market. So whenever you sight or identify this kind of candlestick pattern, you are expected to sell, because this is telling you that the sellers have taken over the market from the buyers. So this is an evening star telling you that the sellers are in charge of the market. So when you see this type of candlestick pattern, you are expected to sell. Okay, you are expected to sell. Now you have understood how the candlestick pattern works. You have understood how to read the candlestick, and you have understood the different types of candlestick pattern that are profitable in the forex market, which I have shared with you. So right now we are going to form a strategy, a trading strategy, using this candlestick pattern that will give you a 90 to 95% win rate. So before you start, the first thing you have to do is to look at the market structure. You know whether if the market is in a downtrend, in a uptrend, or just ranging. So the first thing you have to do is to look at the market structure. Number one, after you have identified the market structure, let's assume the market might be in an uptrend or a downtrend. That is the market structure. The next thing you have to do is you look at the area of value, the area of interest, that is the support or resistance level. You can use support or resistance level. You can use the dynamic support or resistance level. You can use the EME, the exponential moving average. You can use the trend line. So whenever you enter the market, look at the market structure. If the market is in an uptrend or downtrend, the next thing you have to do, you look at the area of value, which is the support and resistance level. So you can use the trend line, you can use the horizontal line, or you can use the moving average, exponential moving average, to identify support and resistance level. So when you have identified support and resistance level, you do what? You wait for your entry trigger. And what will form your entry trigger? That is the candlestick pattern. You wait for the candlestick pattern. So where do you wait for the candlestick pattern? At the support or resistance level. That is where you wait for the candlestick pattern, because that is what will tell you whether to go up or to go down. So if you identify a candlestick pattern in a support or resistance level, it gives you a strong confidence. It gives you confidence that this particular price will go in the direction that you are expecting it to go. So this is how you are expected to trade using the candlestick pattern. So I'm going to give you an example of what I am talking about so that you understand what I'm talking about. So this is an example. First, you identify the market structure. Like now, you can see that the market is in a downtrend, right? Now we can identify that the market is in a downtrend. So what you have to do is, after identifying that the market is in a downtrend, you now wait for an area of value. Now, where is the area of value? So this is the area of value. This is a resistance level. This is an area of value. So you wait for the market to come to the area of value, right? Now the market went down and then came to the area of value. This is the area of value. So what next? You now wait for your entry trigger. That is, you are waiting for the candlestick pattern. You wait for the candlestick pattern to form, and this is it. You can see this is a shooting star. You can see it. Now you can see the rejection forming a shooting star. You can look at it, look at the green, look at the small red, and look at the red again. So this is a shooting star candlestick pattern. So if you check our previous shooting star, you compare, you see that they are the same. So after you have confirmed that the price have come to the resistance level and you have identified the shooting star candlestick, the next thing you have to do is to take your sell trade at the close of this red and put your stop loss above here. So this is how you trade, and you can see that the market is now going down because it makes a rejection here, and then the market is now going down. In the next example we are going to look at here, we have to, so the next example here is, you look at the market structure again. You can see the market is in a downtrend. This time around we make use of the dynamic support and resistance level, like we are making use of the moving average here. This is an exponential moving average. So now the market is in a downtrend. What do? You look at your area of value, the moving average. This blue line is the moving average, that is the area of value. So you wait for price to come to your area of value, and after that you wait for an entry trigger. Now you can see the price has entered the area of value. What do? You wait for an entry trigger, which is candlestick pattern, and this is the candlestick pattern you're waiting for. This is bearish engulfing pattern. This big, or let's say long red candlestick, this is the bearish engulfing pattern, telling you that there's a strong rejection at this resistance level. So what do? You wait for the close of this red candlestick and place your sell trade here and your stop loss above here. I can see you'll be able to ride the downtrend. You can see the downtrend going down. So it's very, very important that you trade this way. Always identify the candlestick pattern at an area of value, which should give you a better entry level or a better entry trigger. So another example I have here with me, you can see the market is in an uptrend. Looking at it, you can see the market is an uptrend. We have the dynamic support level, which is also the moving average. Now what do? You wait for the market to come to an area of value, because you have already identified that the market is an uptrend. You wait for the market to come to an area of value. Now the market has come to an area of value. What do? You wait for your entry trigger, which is the candlestick pattern. Now you see the candlestick pattern has already formed here. Gives you a bullish engulfing pattern. This is a big green. You can see how the green engulfs this red, telling you that the buyers have stepped into the market. So what you do now, you place your buy trade at the close of this bullish engulfing pattern and put your stop loss below the moving average, and you can now be able to ride this huge trend, right? So look at another example here. The market came back again to the area of value, and then you have the bullish engulfing pattern. At the close of it, you place or sell. Look at another example here. The price came to the area, the price comes to an area of value, which is the support level. You now wait for a trigger entry, which is this bullish engulfing pattern. Then you wait for it to close, and once it closes, you place your buy trade here and put your stop loss below this dynamic support level, this moving average support level. So this is an example of how to trade using the candlestick pattern. So let me give you the last example here. Now we are using the trend line. Now you can clearly see that the market is in an uptrend, and we have used the trend line to confirm that the market is in an uptrend. So what do? You wait for the price to come to an area of value. Now this is an area of value. Now the price is at the area of value. What do? You wait for the candlestick pattern to form, and this is it. This is bullish engulfing pattern. You can see the long green candlestick telling you that the market is going up. The buyers are in charge. So what you do is you wait for this candlestick to close, and you put your buy trade here and your stop loss below here, and you can now be able to ride the trend. So this is how you trade the candlestick pattern. So if you are able to master this candlestick pattern, you're able to master it very well, I tell you, you are going to make so much money from the forex market. This is not too difficult. I will encourage you all to go to the demo account and master this candlestick pattern. Practice it very well, because practice makes perfect. Everything that I'm teaching you here, you have to go and practice it in your demo account before using it in your real account. And I promise you, this will give you 90 to 95% win rate, and you'll be smiling every day in profit. So ladies and gentlemen, that is all I have for you in our today's video. If you love this video, give us a thumbs up. Don't forget to subscribe to this channel for more updated video like this, and also don't forget to share this video on your various social media handle. I remain my humble self, Austin Ikeru, and you all are welcome to Ostino FS. I will talk to you again in my next update. Goodbye.